Welcome to the second part of corporate finance lecture. Let's look at the cash flows for a replacement project. In fact, our lesson on a replacement project is relatively easy, so one slide is enough. The whole lecture can be done in one slide. And the trick about a replacement project is that you look at differences in cash flows. Compare this project, for example, if this is a machine with the old machine, and see how purchasing the new machine would change cash flows. Use differences in cash flows. The first item is sale of the old asset. This reduces the initial outlay of cash, and of course we have to consider an after-tax proceed. So initially at time zero, we put our cost is smaller because we would make some money from selling the old machine and paying taxes on the proceeds. The second area that we have to look at differences, and this one is a little tricky, is to look at the depreciation difference. The old machine was giving us some depreciation per year. The new machine, given its higher cost, will give us a different amount of depreciation. But we should use only the difference between old and new depreciations in our formulas that we've seen so far. Finally, we look at operating cash flows. Here too, incremental cash flows or differences in cash flows between new machine and old machine matter and should be calculated. Otherwise, replacement project is similar in use of calculation methodology as something that we have already done together. Now let's look at inflation. Inflation affects our capital budgeting decisions, particularly in countries where inflation is large. For example, if we have inflation that exceeds 100% over a period of 3 years. If we are looking at inflation, we should make sure that there is a matching of interest rates that we use for discounting and the cash flows. They both have to be, for example, nominal cash flow and nominal interest rates. Let's recall the difference between nominal and real. Nominal interest rate is an interest rate that the bank quotes you, the quoted interest rate. How much do I pay for interest? Real interest rate is you adjust this nominal interest rate for inflation to show what sort of consumption this additional payment would allow you. So it's adjusted for inflation. This word real is a bit confusing because real interest rates are something that in the back room a financial planner or a professor calculates. They are not the interest rate that you see in the marketplace. The interest rates that you see in the marketplace are nominal interest rates. So match cash flows with correct discount rate. Do not use real interest rates with nominal cash flows or vice versa, real cash flows with nominal interest rates. Then we would get a calculation problem. Keep in mind that most of our work in CFA is to focus on applied uses of methodology and make sure that we make correct decisions in real world rather than generating theoretical knowledge. If inflation is higher than what we expect, there would definitely be an effect on depreciation. and that effect is negative. High inflation reduces the value of the depreciation tax shield. I would explain this in detail in my next slide with some numbers. Um, Inflation also decreases the value of fixed payments to bondholders. In fact, anyone who pays off a loan and has a fixed payment would benefit from inflation because 1,000 units of the money today is not buying the same amount that it bought yesterday. So paying 1,000 becomes easier for us at inflationary time. When prices have doubled, now this 1,000 buys half as much, and it's easier for us to pay it. So payment to bondholders becomes um, cheaper and easier for us to make. And of course, because the bonds are paying the old interest rates, which were low, inflation causes interest rates to go up. And there is an inverse relationship between an interest that a bond pays and its price. Therefore, as the current interest rates become higher, the old bonds that pay the old low interest um, become cheaper. And it's easier for us to, for example, purchase these bonds back if calling the bonds or purchasing them back is allowed. Inflation also has different impact on revenues versus costs. The timing matters, and the timing of revenues and costs are not always the same. Revenues come at the end of the period, and costs are incurred early on and in the middle of the period. Later amounts would increase um, with inflation, and early amounts are smaller with inflation. And this is also something to carefully consider. Let's go to a numerical example about why inflation reduces the value of depreciation tax shield. Imagine that you purchase a computer for 1,000, say $1,000, and imagine that you depreciate it for 4 years. So on a straight line depreciation, each year 250 is deducted from your income, and therefore you save on taxes because you report 250 less income to the government. Now imagine that there is 100% inflation to make this example dramatic. So the computer prices after a year go to 2,000. You can sell your computer and purchase a new one for 2,000, or sell the same one and buy it back. Then your depreciation would be 2,000 divided by 4, or 500 a year. So you see that depreciation um, tax shield could considerably increase if we purchase new assets in inflationary times. 500 a year buys what 250 purchased in the past. That is, the value of depreciation tax shield is half of what it used to be if we keep the old asset and we have 100% inflation. Now let's go to looking at optimal capital projects where we have mutually exclusive projects and their lives are unequal. There are two methods to use here. One is called least common multiple of lives approach, and the other one is called equivalent annual annuity approach. Finally, we want to discuss capital rationing. Let's start with projects with unequal lives. Imagine that we have two mutually exclusive projects with different lives. Um, no cash flows are given here, and project cost of capital is 12%. Net present value of the first project, we call it a book press project, which has a life of 6 years, is 3,245. All right, so our cost of capital for this project is 12%. One project has a life of 6 years and its net present value is given to us, $3,245. Of course, the units could be thousands. The other project has half of this life, 3 years life, and its net present value is 2,577. If you just compare these two net present value, the net present value rule says that the project that makes us 3,245 has a larger net present value and makes us wealthier. But these unequal lives tell us that the 6 year project may not be better because if we could repeat the 3 year project twice, we make twice 2,577, especially if the net present value stays the same. Of course, that's a little simple-minded, but the underlying reason works. Um, 6 years is a longer time to generate this $3,245 wealth. So it might be better to repeat the 3 year project twice for 6 years. Let's see how it works precisely, because in CFA you have to do precise calculations. Our first method is called least common multiple of lives method, and here are detailed cash flows. Initially we pay 10,000, let's say dollars, to start the project. Then it makes us 3,500. Next year 6,500. Third year 6,000. Fourth year 3,500. Fifth year 6,500. And sixth year 6,000. Net present value of this project at 12% is $4,412.01. Internal rate of return is 25.2. Again, practice to calculate this internal rate of return using your calculator. If this project was a 3 year project and we repeated it twice, at year 3 we have to pay another 10,000, so we would have this minus 10,000 that you see here. And of course, we are assuming that all other cash flows are the same. So this project, when we renew it, makes 3,500 again as it made in year 1, and 6,500 again as it made in year 2, and finally 6,000 as it made in year 3. So this would be a project that is repeated twice. Now that minus 10,000 plus 6,000 gives us a net cash flow of minus 4,000, and our calculations is for a project with these given cash flows, except year 3 the cash flow is minus 4,000, and as I stated before, at 12%, net present value of this project is 4,412, and that is more than this 3,245 that the 6 year project, a project with a life of 6 years, generated. Of course, we don't have the cash flows for that project, but you could imagine some cash flows that give you 3,245 net present value. So the combined net present value of two projects, let's say this is an offset printer, one today and one in 3 years, is more than the present value of one project, one printer that lasts 6 years. Couple of notes here. It would be imprecise to get 2,577 and multiply it by 2. You see that this net present value of 4,412 is different from 2 times 2,577. And this has to do with time value of money, because the minus 10,000 comes after 10 years. And when we do net present value and do present value of these cash flows, and this timing makes a difference in valuation. This is due to time value of money. The second project's 2,577 net present value is realized after 3 years. Let's go to our next method. We have projects with different lives, and we are going to use least common multiple of lives method. Then we are allowed to directly compare the net present values with each other. The press has a 6-year project and it makes 3,245. And the printer, a common number of years would be 6, because 2 times 3 would also gives us a 6-year. So if we use the printer twice, we get a net present value of 4,412, as we saw in the previous slide. Now these two numbers, which is for a common life of 6 years, can be compared to each other. Of course, this example was a classroom example and relatively simple. We may have a more complicated case where one project is for 5 years and the other project is for 4 years. Then we have to look at number of years where we have a common multiple of lives. In that case, 20 years, using the 5-year project for 4 times and the 4-year project for 5 times would work. Select the higher equal life net present value. Next, we use the annuity formula in a methodology that is called equivalent annual annuity, EAA. We are calculating an annual payment that is equivalent for each net present value project. For the 6-year project, we are calculating the payment. If you go to your financial calculator, you have a present value, and in this case, it's equal to 3,245. You have a life of project, which is 6 years. You have a cost of capital or interest that is 12 years, and future value is always 0, because in the future we completely pay off a loan. We want to know what is the payment for each this loan, so we can borrow 3,245 today and pay it in 6 periods with an interest of 12%. This payment can be calculated with your calculator, and we do the same thing for the 3-year offset printer. The present value is 2,577. The number of years are 3, and the interest is 12%, and we calculate the present value. These numbers are respectively 789 and 1,073. So our decision is select the project with the higher EAA. 1,073 is a better choice. Notice that both methods give us the same answer. Let's focus on this PMT a little bit. One way that we calculate this PMT is from its formula directly, which I reproduced it here for you. The nice thing about CFA is you don't have to memorize this formula. Your calculator has this embedded, and all you have to do is practice with this payment. And of course, some of us use Excel, and in Excel, it may help your memory to see how this is calculated. So let's quickly go to Excel and take a look at it. Here is our Excel sheet. To calculate this payment for an annuity, We say the present value is 3,245. Interest rate is 12%. Number of years is 6. And here we calculate payment, which is from this Excel formula that is in the window. And that's the same as the formula we have here. And we get the 789. This is an Excel template that I would have in Ilias, and you can download. But of course, we are going to focus on doing this problem with a financial calculator. Financial calculators can be also downloaded as an application on your computer, and that might be cheaper and easier to use since this course is computer based. But when you actually take a CFA exam, you can only use the financial calculator that they allow. Next, let us focus on capital rationing. Capital rationing is a fact of life. Even though most of our corporate finance studies are neoclassical in the sense that we assume that when there is a wealth increasing net present value positive project, we would be able to get capital because we make money on it. But that's not what we face in the world of reality, perhaps because there are various frictions in the market that prevents us from getting additional capital. Okay, if capital is rationed, how do we allocate it? Well, we want to allocate it so that we make the most amount of profit. Allocate rationed fixed amount of capital to maximize shareholders' wealth. Maximizing shareholders' wealth is our objective in corporate finance. How do we do this? Well, we choose the combination of projects that have the highest total net present value for this given fixed amount of capital, and that can be best illustrated with an example. So let's move to an example. Capital rationing. In this example, we have a corporation called Omni, and it has a $3,000 capital budget. Of course, the units could be thousands or different. Project A requires an investment outlay of $1,650. We spent this, it's a negative cash flow, so minus $1,650. And it would generate a net present value of 700 for us. Project B, it has a negative cash flow of 1,400 initially, and net present value is 670. Project C, initially we spent 1,100, and net present value of the project is 400. Project D spent 600, and net present value is 200. Project E spent 300, and next net present value is 60. All right, if we look at highest net present value, it's project A, 700. But the point of this example is that it's not necessarily the best to take the highest net present value project because our capital is rationed at 3,000, and if we spend 1,650 on the project A, then we won't have enough money to take project B or some other profitable project. So the way to go about this is to calculate profitability index. And profitability index is defined as net present value plus investment divided by investment. And of course, this is a familiar return formula, and it could also be written as net present value divided by investment plus 1. Okay, so this is easy to calculate. Profitability index for project A becomes 1.42, for project B becomes 1.48, and so on. Please calculate this, taking a minute, and make sure that the calculations make sense to you. So now we go and look at projects that have the highest profitability index. 1.48 is that project B. We take it. 1,400 is gone, and we have 1,600. Now we go and take the second project with the highest profitability. Is project A, 1.42, but we don't have enough money. We are 50 short. We go to the next project with the highest profitability index, and that's project C, 1,100, and we still have some money left, and we go after next project. Project D requires 600. We don't have enough money for this project, but we do have enough to take project E, which is the next one to consider, and make another $60 of net present value. So the highest net present value total under this capital rationing is 650 from project B, plus 400 from project C, and plus 60 from project E, which is 1,130. And the capital that we use is 1,400 for project B, 1,100 for project C, and I have these added up here, and 300 for project E, or 2,800, and this is smaller than our $3,000 budget constraint, and after that we can't take any other project. So this is a nice method to learn, and it would help us choose the best combination of projects when there is capital rationing. Next, we are moving to a number of definitions that we know. We should be able to define for CFA what sensitivity analysis is, what scenario analysis is, and what Monte Carlo simulation is. Most of these methodologies require a computer program, and usually in CFA exams, we just define this and have a working understanding of the methodologies. So let's start with sensitivity analysis. It says, start your analysis with a base case and go through your complete capital budgeting decision. Then go to a computer. Usually an Excel program is sufficient. We put our data in that Excel and we try to change a single variable. For example, we say, what happens if our sales figures are much lower than expected or much higher than expected? So we change our sales numbers. Or we change our variable cost, but only one variable at a time. Or we change our fixed cost. Or government comes with a new tax rate. We change the taxes, especially if new tax rates are discussed in the news. We change the cost of capital. Each one of these items are changed, and then we look at how net present value changes. We're really searching for disasters that can wipe out our profit or eat into it. Which variable is critical, and if it changes somewhat, it would hurt us a lot. We go one by one and change different variables that go into the analysis. The final stage is to plot a net present value curve versus each one of these variables. So visually we could see how sensitive our profit would be to changes to these variables. More sophisticated analysis would involve calculating a beta or a slope of regression for this graph where we have net present value versus one variable. And then we would discuss that projects that are more sensitive, that have net present values that are more sensitive for a given variable, are riskier projects than the ones that have less variable. Scenario analysis is similar, except that we consider, for example, three different scenarios: the base scenario, the best case scenario, highest possible uh, sales, for example, and the worst case scenario, lowest possible sales. And we compare these three cases together. So above analysis using only best case, worst case, and most likely case scenarios is done. Then we can calculate the average profit, for example, or average of variables that are interesting to us, and we can calculate their standard deviation. The most interesting variable is often net present value because it adds to our wealth. So if the net present value has a high standard deviation, we say this project is much riskier than assumed, and we of course look at the average of it as a likely amount of net present value to make, um, given that we could have best or worst or likely scenarios. Monte Carlo simulation is more sophisticated. It requires us to specify the probability of different events. Usually we pick a distribution from a computer program, a normal distribution, for example, binomial distribution, and we put this distribution on a variable and have the computer simulate different net present values based on the project um, um, project's net present value being calculated uh, for various numbers that each variable, such as sales, takes under this probability distribution. Um, with a computer program, we can change several variables at the same time and graph a multi-dimensional graph uh, where these variables changing to each other and their interaction can be shown. We do a random draw from each distribution. We calculate net present value. We repeat these random draws and net present values a larger of times, for example, 1,000 times, um, and we generate empirically a probability distribution for that net present value. And of course, the variance of this distribution would talk about the riskiness of that net present value. So this method is more statistically sound and scientific, but of course needs lots of computer calculation. Next, let's talk about calculating the discount rate that we use. And of course, this is a review from CFA 1, but I promised that the lectures would be self-contained. And so for calculating the discount rate, we use capital asset pricing model, or CAPM. And the formula for CAPM says that the return on a project, here R of a project, let's say how much money Siemens is supposed to make you as return. That equals risk-free rate, how much money loaning money without risk to government would make you, plus the riskiness of that project measured by its beta, and that is multiplied by how much the whole market, let's say um, DAX or Dow Jones Industrial Average, how much the expected return on the whole market was, and subtract from that the risk-free rate. So this would be an excess return. This would be how much more the stock market paid, more than the government paid. This CAPM formula is a formula that we should know by heart, and gives us a relationship between risk and return. Let's move to real options. Um, First, the definition of real options. These are options where the underlying asset is a project or um, real estate. Um, Usually, these options give us extra value. So, in capital budgeting, we keep in mind that real options do not subtract value from the project. Of course, options may be costly, therefore, a cost for the option when we calculate real options should also be considered. Let's look at some more concrete examples. Managers have the option to make future decisions that can change the value of the project that we consider today. A classical example is the option to abandon a mine. If we calculate the net present value of the mine and then there are many years of losses at the end, well, they all subtract from the value. But when we get to this time where the mine is getting close to being depleted, and there is, for example, less gold in there and it's much costly to extract it, we could simply close the project. This is called abandonment option. And this would add to the value of the project because we don't have to consider all those negative cash flow years that are coming way at the end. The underlying asset for a real option is a real asset. That's why we call it real option. And here the word real is as opposed to financial. So financial asset is a contract that gives us a sharing rule, real asset rather than a financial asset. And of course, there are real call options and real put option. This abandonment option that I talked about is a put option because we have the right to uh, sell the underlying asset by stopping it, closing the mine. Mine is the same as getting rid of it. It's a put option. Real options can only improve net present value estimates for projects. So this is an added value. We calculate a base and we add the value of real options, the best that you can estimate it. Here are a number of real options that you should know for CFA. Number one, timing option. We could wait and make the decision later when the better information comes. So this is a call option. We have an option to take the project, but we could wait for this project value to change and better information to come and better um, estimates of cash flows, which are now better and higher, may emerge. We may figure out that the cash flow is higher than we know now with faulty information. Abandonment option is something that I discussed already. We could get rid of this project. We could exit it early at a failure time instead of waiting to the bitter end and suffering many years of losses. This is, of course, a put option. Um, Most of you are familiar with options, but if you're not, option gives you the right but no obligation to buy the underlying asset, that would be a call option, or to sell the underlying asset, that would be a put option, at a fixed price that is written in the option contract. Expansion. There's also an expansion option. It means that we have the ability to invest more on follow-on projects. These projects may open up the market for our product and our additional future products. And this is a call option in case of success. There is a flexibility option, and one aspect of that is that we may have the ability to set the prices as we get more market power. For example, like an Apple cell phone, for quite a while we can charge higher prices after successfully capturing um, a foothold in the market. Um, Also, we may have production flexibility, which means that we can use different materials and make a variety of different products based on knowledge and ability as we produce this product over time. And that may reduce the cost of the project. Um, mm, uh, Finally, there is a fundamental option. The fundamental real option means that the entire project might depend on an underlying asset. For example, if the project is gold mining, well, its value depends on the value of gold. So uh, mm, it's a fundamental option. Evaluating the projects with real options is simple in the sense that the value of real option always is added to the value of net present value of the project. But calculating the value of a real option itself is not easy. Fortunately, in CFA classes, uh, we are not required to use Black and Scholes or any sophisticated option calculation models, and therefore you often end up adding a given value for the option to the net present value of the option, or you are questioned on your understanding of these definitions. So step one, determine project net present value without the real option. This is our old work of calculating um, present value of all the future cash flows and adding them up. Step two, add estimated value of the option to the project net present value. And of course, this requires calculating the option value, which is done with Black and Scholes or binomial option pricing models. And there are also decision tree models, but again, none of those would come in our CFA Level 2 lectures. Let's look at some typical CFA exam questions. Here is an example of flexibility option. In this question, we are given the net present value of a new production facility um, as minus $6 million. This project has a negative net present value. There is an option cost of 3 million, and by option cost here, they mean that we can build additional capacity by spending 3 million. And this option would allow us to produce more in the future, and that would give us an option value of 10 million more in expected future income. Notice that the option value is given to you. It's not something that we need to calculate, and that's really the difficult task in real world projects. We need some option theory for that. Now the overall problem becomes relatively easy. You say the overall net present value equals the project net present value minus option cost plus option value, or in other words, minus 6 minus 3 plus 10, or 1 million. Therefore, a net present value negative project is turned to a net present value positive project after we consider this flexibility option. Next, we are required to know some pitfalls of capital budgeting methodology. This is a discussion that we do verbally, and familiarity with some of these problems is required. Here are the problems. Number one, when we do these numerical calculations, we do not consider what competitors will do. what the market would, what kind of response the market would give, how would it react to our investment. And of course, if competitors follow us, it may change these cash flows, and this analysis should be done in addition to capital budgeting, mathematical and numerical calculations. For capital budgeting, often employees use Excel sheets that are pre-cooked and made to a template. And often people don't understand all the formulas and all the calculations that go into that Excel sheet. So we shouldn't fall into that trap. And of course, throughout these lectures, we looked at all the formulas separately, so that would prevent using Excel templates. And to be more precise, CFA requires us to use these financial calculators that would prevent us from being stuck with Excel templates. But Excel templates are a fact of life in real world finance. People have emotional adjustment to the projects that they have an ownership of. We could call them pet projects. And these emotions affect the calculations and decisions. And that is a pitfall of capital budgeting, because these numbers are sometimes used to justify pet projects. This also works with consultants. Management may have a pet project that they like, and they push consultants to have numbers that justifies it. Often for capital budgeting, we use book values. Book values come from our balance sheet, from our income statement, and their effect on our return on equity, their effect on our earning per share. All of these are from accounting books. And we know that book values are subject to manipulation in accounting. One can take different depreciation, one can borrow more and or less and affect these cash flows. This would make our net present value calculations suspect in capital budgeting. Um, Internal rate of return calculation has its own pitfalls. Sometimes IRR can go wrong. And this is especially for projects that are similar to lending money rather than borrowing money. Net present value is usually the method to use, but often in practice, IRR appeals to people and they're forced to use it. So we should look for pitfalls of capital budgeting that comes from wrong uses of internal rate of return. Cash flow estimates are an art by themselves. They require pro forma accounting statements, and sometimes we may not reach these goals that we are forecasting for future. So cash flow estimates could be wrong, and that would affect our capital budgeting, and it's a pitfall. Mm, Overhead costs are often overestimated or underestimated. For example, one may not accurately calculate how much room we need in the factory or how much space we need for this project. And if our building is not large enough, perhaps the project requires an expansion of facilities and buildings, and that's a cost that we haven't calculated. Discount rates might be incorrect. We might use our current cost of capital, and the project may affect our cost of capital, make us more risky, and cost of capital may go higher. There are also um, relationships inside the corporation, what we can call internal politics. that could affect capital budgeting. For example, a new project may cause tensions among our employees and managers of this project and all projects, and may this may affect the um, cash flows of the project. Um, Going with a project might mean that we stop research and development and looking for alternative investment ideas, and that may cut into our innovation and finally into our future cash flows. And of course, some costs are something that we talked about before, and they should not be considered. But people have an attachment to all the costs that have gone into considering whether to do a project or not and studying it. And a pitfall is that some costs are uh, somehow find their way into analysis. Opportunity costs are also important. As I mentioned before, if you work in the project yourself, you have to consider the opportunity of getting paid at a comparable work somewhere else. And if your own money is put in as capital, of course, you should consider the cost of that capital